Hey, what's up? This is Silver Surfer from LifestyleTraining101.com, and it is Memorial Weekend, end of May, and last Friday. I wanted to review what happened in the past couple of weeks, going into this weekend. Obviously, we on Friday we went into 2098, and actually this Monday we traded into 2102. But there's also a lot of stuff that happened in the last couple of weeks that I think it's worth reviewing. We'll also talk about an option trade that I recommended on Friday and how that option trade, that bull put spread, is different from bull put spreads that I recommended in the past, largely due to changes in the market condition. So if we go into this weekend post and we take a look at this daily chart, right? So this daily chart, basically this B wave high and then this ABC wave in May corresponds with, if you look at the hourly chart, this B wave high and then an ABC, right? So during this ABC, we have we had an AB. So this is the AB 1, 2, 3, 4, 5, right? So that 4 is an ABC. So you could count AB 1, 2, 3, 4, 5. And that's A wave. Then it went up in a B wave, 1, 2, 3, 4, 5. Had a double top there. And then we had an H-shaped wave 1, which is basically 1, 2, 3, and then overnight 4, and then 5, and then bounce. So that's an H, the letter H shaped, and then bounce 2. And then that too was the rally into the Fed announcement on that Wednesday, May 18th. All right, so we rallied into that Wednesday Fed announcement, and then once that Fed announcement came out, dropped in a wave 3, and right at the close, basically bounced, back here. Overnight went like this. So you can think of it as a 1, 2, 3, and then 4 is an ABC. It's ABC. Now that obviously that C didn't go up that much because it's way lower than where that A was. But I guess you technically could count it like that and then have a fifth wave low that broke the critical support at 2030 and 2040. It broke it only temporarily and it quickly bounced back up. So the tough part, and this is tough with any corrective action, is when is the bottom? Is it you have this 1, 2, 3, 4, and then a 5 down that goes one? Do we have that one more low, or is that it? And it turns out between those two options, that was it. Obviously this happened so quick that I lean towards this being a 1, 2, 3, 4, and then just one more 5. But the thing is, during that time when I was expecting that one more 5, it just consolidated. And so, I did make the mistake of recommending a bearish trade when these critical support levels were broken. And all along, I've been saying that I've been bullish. And from the 2040, 2030 area, we should be going up. But the thing is, we broke those critical levels, and I thought I was wrong. And so I switched directions. And that's really where my mistake was. I should have gave it a little bit more time to prove that it would stay below those levels. And instead, it only stayed there for a couple hours and then bounced back up higher than this fourth wave, closed there, and then went up even higher the next day, and then it consolidated. And the thing is, if this were a 1, 2, 3, 4, 5, this kind of consolidation should not have happened. And when I saw this kind of consolidation happening, I gave an alert saying that I was exiting half position in case I'm wrong, because it seems like it wasn't acting like I wanted it to. It sold off into the close, and the following overnight, it had this drop, right? And then after that drop to 2041, it could not break to 2040, right? Support as 2030 and 2040, and it could not break that support again after breaking through it and then bouncing back up, and then from there it just rocketed. The good thing is we caught the buy on the Nasdaq, and actually the Nasdaq was a better buy than the S&P. But I thought it's important that whenever you have these corrective things where it's like an ABC, going back to the daily chart, you have this AB 1, 2, 3, 4, 5 ending diagonal or leading diagonal in the A wave position. You have a B wave bounce. That C wave, this kind of C wave did not look typical, all right? So we had an A, B, C, but that C was involved a Fed announcement, and it looked like this. It was very quick. So one thing to note is that when there's corrective action into a C wave bottom, you may or may not always get that 4-5, right? So we had that, 1, 2, 3, expecting a 4-5. That 4-5 is not guaranteed. It could extend like it did in the bottom of February 2016, that bottom off of, in 1800, it extended. In this case, you didn't get the 4-5, and sometimes it can truncate. So that's what makes trading corrective actions difficult. However, the key was when this trend line, when this consolidation happened and this trend line was broken, you have to, if you are in a bearish position, you have to exit and you have to switch directions. It's very important not to fall in love with one direction. You never marry a trade, right? So whenever the market tells you otherwise, you just have to change directions, completely exit. And that's exactly what we did. So if we look at the Nasdaq chart, the Nasdaq hourly chart, all along I've been saying 4,300 and 4,280 is strong support because the ending diagonal that happened ended at 4,280. And so, yeah, we bounced up and then retested it one more time before we went up. And the key line to look at was this trend line. And we weren't sure if it would test 4,280 one more time or if that's it. And you get your confirmation once you break this trend line. And we broke this trend line that morning of the 24th, and that's when I alerted a buy at 44.05. Sold it, held it overnight, sold it at 44.63 or 64, somewhere around there. And the interesting thing is, if you look at this is the daily chart, and I put this count out actually a while back, saying that this was potentially a wave 2 bottom because this is so extended. AB 1, 2, AB 1, 2, 3, 4, and then here's a diagonal. The big 1, 2, 3, 4, 5, right? So the ending diagonal in the fifth wave position. None of the other indexes had this, but this had an ending diagonal, a big 1, 2, 3, 4, 5 into 42.80, and that was in the fifth wave position. So that gives me more confidence that this is like a bottom, and then from there we should go up. Now I did not expect to have this B wave to be like, this kind of structure, this much kind of like up and down. It was really choppy. But the thing is, once we clear this trend line, this downward sloping trend line, it's a clear buy, and that's why I alerted the buy at 44.05. Wish I would have alerted at 43.80 in the pre-market, but hey, hindsight is 2020. Now, there's no guarantee that we're in the third wave up. It's possible. It's also possible that this was just an A wave. We have a B wave up and then a C wave down. But this possibility does exist, and the fact that we have so many strong green candles makes me, at least for now, favor this count. So ideally, what I would like to see is for this Nasdaq to kind of, you have a 1, 2, 3, and it was trying to do a fourth, but instead of doing an ABC fourth, it just did a tiny fourth and had an extension. So we're actually potentially still in the third wave, and I expect it to go, it closed at 45.13. I expect it to go a little bit more, maybe into the 45.30s, 45.40s potentially, and then pull back in a fourth wave below 4,500, and then in a fourth wave, and then in a fifth wave, potentially challenge this high in the upper 4,500s. And then from there, that would complete wave 1. And from there, probably some kind of wave 2 drop back below 4,500 and then if it holds, and I'm guessing it might go towards 44.40. Remember on the way up, as we rallied, I said, if we can clear the 44.40 area, 44.42, then that would be really bullish. And we did clear it, and it does look like it's in the heart of a third wave. We may retest that in that wave 2 pullback, and assuming that holds, then we could have a strong wave 3 after that. So obviously we don't want to marry ourselves to this this wave count and adapt according to what we see. But at the moment, I'm expecting the extended third wave to go a little bit higher, pull back, and then push one more time, and then pull back in a wave 2. So we'll see if that even happens. Now the corresponding look for the S&P would be, this. Basically, we have an AB 1, 2, 3, 4, 5 leading diagonal in the S&P, leading in the A wave position with a B wave pop, and then what I see as like a shortened C wave, right? So the A wave took longer than the C wave. We had that wave 1, and then we had that consolidation wave 2. When I said that the market was stalling, it basically didn't move for like an entire 48-hour period. That's consolidation, and that does that's a clue that fifth wave down would not happen. So bears would not want to see consolidation. We saw consolidation then, we popped up, and then we saw consolidation again here. And then only in that last hour on Friday, before the 3-day weekend, the 3-day Memorial weekend, did the market push up. So consolidation at high levels usually means one more push up. So I would imagine once this push up finishes, that would be the completion of wave 3, and then after that we would have a fourth wave, ABC, and then a fifth wave push up. Oh, actually a fourth wave here, and then a fifth wave push up to maybe surpass that prior high just by a little bit, and then a wave 2 drop. All right, so once you finish that, that's then you have another 1, 2, 3, 4, 1, 2, 3, and then an ABC fourth, and then finally a fifth wave up, and that finishes the entire wave 1 from here all the way here, and then from there we could get a wave 2 drop towards the 2000 area. Now, so if you look at this pattern right here and compare it with this, notice that we basically had like a 3, and then this red 4, and then 5, and then that completes wave 1, and then wave 2 was a drop that goes below the bottom of wave 4. So we could see something similar here, where it's like you have a 1, 2, 3, lots of green candles, and then you'll see some red candles followed by a fifth wave push, and then red candles that go below the fourth wave. That's why I have this bottom is lower than that bottom. That finishes wave 2, and then we have a third wave up followed by a fourth wave retracement, and then fifth wave up and wave 2 drop. So that's kind of like my tentative outlook. Obviously I have to adapt to what I see, but that's so far what I'm leaning towards. So this is the S&P 500 hourly chart, and this is the consolidation that we had for more than a 48-hour period of basically the market going nowhere. And whenever that happens, you have to think of that as consolidation rather than a fifth wave down. And so the key is when it broke out over 2060, and when it goes up this high, it's very difficult to say that we should buy after it went up like 50 points or even more than that. But here's the extension, right? So how do I know that there could be a buying opportunity here? I mean, I alerted a potential bullish trade on Friday that I got spooked out of, but still, why did I think of a bullish trade rather than a bearish trade up here? Well, the thing is, there was a fourth wave here, and I was looking for an A, B, C that never happened. So if you saw an ABC, it would have been A, B, and then C should have, at this point, sometime during May 26th, we should have broken that low here. But we didn't. Instead, we touched closer to the highs. and what we saw was a series of A, B's or 1-2 consolidations. And what do I mean by that? Well, if you look at the 5-minute chart, basically we had, so this is 4 p.m. on that close. What is that? May 26th closed on 4 p.m. We had a wave 2 drop into the close and then a bounce. So at that point, I think I said, I said what follows next may either be a series of 1 and 2s as long as 2087 holds, or a wave 3 through the overnight session. All right, so if you look at this chart, drop to 2087, we either get a wave 3 up, which we did not get, or we get a series of 1-2s or a series of ABs. So what is that? That's basically an A, B, C, and then drop, right? So it's a failed here, and then you have an A, B, C. So you can think of this as a bigger A, and then this as a bigger B, right? So ABC, ABC, do it again, ABC, 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 ABC. This is that. So during this coiling up phase on Friday, this is when I alerted the bullish option trade, because it looked like we were consolidating up, and there would be more upside. My mistake is, well, I knew the Fed and Yellen would make an announcement sometime on Friday. I thought it was at 12:30 p.m. And so by 1:30 or so, I was thinking, okay, maybe the announcement was made already, and it seems like the market didn't react. So we're approaching the close of Friday. I may as well recommend now. I really should have just waited until the last hour instead of at 1:30. So at 1:30, I initiated the trade at 2094, and then finally the announcement from Yellen came, and that's kind of spooked me out, because I was thinking, as long as 2087 holds, we're gonna go rally into the weekend. But the thing is, the announcement came, and the Fed always can change the market drastically. So in order to protect myself, I had to exit this bullish option trade. But really what I should have done was stick with it. And so if you think of it, ABC and this Fed announcement drop would be A, the bounce would be B, and then retest the lows in a C before finally you get that rally. So a series of ABCs, AB, 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 then you finally get that rally into the close. So I did end up re-entering my trade, but I didn't want to like flip-flop so many times with the alerts. But nevertheless, I think it's a good learning exercise to point out that the option trade, let me bring up the option trade. All right, so here's the option trade. Shorting the 208.5 strike, which is, I guess, roughly the 2080 or 2085 regions, betting that the market will stay above that region. We closed at 2098, and actually today, Memorial Weekend, if you look at the charts, the live charts, we actually closed on Monday, Memorial, the holiday, at 2102. So it actually went up from the close at 2098. It rallied into 2098. We're at 2102. And what I want to bring to your attention is this guy, right? So we only got 47 cents of credit for each option spread, right? So typically when I recommend a trade that's, 15 or 20 or 25 points away from where the market is currently trading, when I short that strike, typically I'm looking for 70 cents. The fact that we're only getting 47 cents means that like the amount of premium that we're collecting by shorting the option is not as high as it used to be, right? So if you look at this daily chart, back when I recommended bullish put spreads, in these areas where the volatility was higher, the amount of credit I was getting for each option spread was like 72 cents. That's good. And the thing is, as the market goes up and as volatility decreases, right? So whenever you had this huge third wave up, volatility decreases. And if you go to FinViz, you go to VIX, you can look at the daily chart and see, you see how volatility had just basically went down like crazy. And whenever you have low volatility, it's going to be really hard to collect much premium, because the higher the volatility is, the more option premium you can sell. When volatility is low, there's not too much option premium that you can sell. So the best time to sell options was when the volatility is elevated above, let's say, 18, right? So back in February, it was great. Even March could have been good. But in this kind of April-May period, it's a little bit harder. So we're only getting 47 cents in credit. And so I did 20 of these guys. So if you multiply this by 10, that's 470 times 2, that's 940, right? So you get maximum profit if this expires next Friday, June 3rd, of $940. Your max loss, however, is $9,000, right? So that's almost like a 10-to-1 ratio. Normally, I like to get 70 cents of credit and do 15 options, so that's like $1,000. And then that's the $1,000 max profit, and maybe your max loss would be $4,000 or $5,000. Your max loss happens when you exceed or reach 204 in the SPY. That's like if it drops a lot, all the way down to 2040. And so this kind of 10-to-1 ratio, I'm not that excited about. I'm much more excited when the ratio is closer to 4 or 5 to 1. So basically what I'm saying is the risk reward of the bullish put spread strategy was better in February than it is right now in May, or end of May or going into June. So it's just one example of how the different strategies have different risk reward kind of ratios and metrics as the market conditions change. So if you look at this chart, the best place obviously to do the bullish put option spread is when the volatility is high. It's basically when the market drops a lot, that's kind of like the best time when it's about to rise. This month of March was great for executing bullish put spreads. Now that the market has rallied a lot and volatility is low, you're going to get less reward and you're going to risk a little bit more. But my incentive for putting on this option trade on Friday of a 3-day weekend is really for the time decay, right? So I recognize that this is not exactly the ideal kind of risk reward profile, but the reason why I wanted to do this is because there's only like 1 week left to expiration and volatility is low. If volatility is low, it's a small chance that the market will just drop dramatically against me over the 3-day weekend. And therefore, I think if you just hold it just into Tuesday morning and you exit the trade, you could, this 47 credit could potentially go down to the low 30s or high 20s, and you could just exit that. And you basically, even if the market goes nowhere, you'll just collect time decay for basically Sunday night trading into Monday and then finally into Tuesday. So you get actually a good amount of option time decay over a 3-day weekend versus a 2-day weekend. And so I think the risks, the opportunity to capitalize on time decay was decent, especially if the volatility is low. But I do recognize that in terms of total reward for how much you're risking, it's not ideal. And that's something you're going to have to accept as the market conditions change. If we are entering a low volatility environment, then the possibility of getting a good risk reward with option selling is going to diminish. So that's why you got to change and adapt according to the marketplace. So sometimes trading futures would get you, assuming that the market volatility is low, so there's not so much choppiness like last week. If there's less choppiness, then futures trading could be good. If there's a lot of choppiness, then futures trading can be bad. And so, that's something that we're going to have to evaluate as the market changes. So going back to the 5-minute chart, this is when the Fed announcement or Fed notes came out, or Yellen opened her mouth. Um, so the fact that we held 2089 and then started rallying above, I would say that the point of confidence came really just like in the last 15 minutes or so of trading on Friday. So when it became clear that we were gonna go above 2094, then it was clear that okay, we are gonna rally into the weekend, and and a large portion of that rally happened right at 4 p.m. and actually after hours. So if you look now on Monday, I mentioned before, we're already at 2102. Now recognize that 2105 was the previous high, so we are testing into resistance there. So that could be the top of wave 3, and then from there we get an ABC wave 4, and that could bring us below 2100 once again. For now, this is my daily chart prediction. I think we're going to retest that 2105, pull back, and then try to attempt it one more time, and then pull back again, and then finally do a third wave in over 2150, consolidate, try one more time again over 2150, and then potentially fail. So that's assuming this is a 3, 4, 5. Now on the Nasdaq, I have it's a 1, 2. Remember, so on the Nasdaq, this could be wrong. This could be a 4, but for now, I see the potential for it to be a wave 2 bottom, and then we'll see if this actually happens. If so, it could be a bullish summer. But again, always adapt. So adapt to whatever you see the market's currently doing. I'm not gonna fall in love with this position if the market tells me otherwise. I'll end off with a few graphics. So yeah, aborting an extended third wave too early makes you feel you wish you held down. Totally true. I mean, like we bought this breakout at 44.05, cashed out at 44.64, and yeah, we wish we could have held on. There was a possibility of an ABC drop. Obviously, we always want to cash out frequently because you want to make sure you don't turn a winner into a loser. So that's the number one most important. But that's the thing with extended waves. Extended waves are difficult to trade because there's a risk that it could fall. A lot of people are saying, "Oh, it's a rising wedge. Once it tops, it's gonna drop hard," you know. And there's also the ABC fourth wave possibility. But with extended waves, it's very difficult to find a good buy entry because ideally you want it to retrace first and then buy. But with extensions, you just got to buy, and then as long as it holds, critical support level, it'll go up. And for the S&P, that was that 2087 region right here. It held that throughout the whole day, and really anything above that should have been a buy. And a few more graphics. We are in a third wave, and in fact, we are in an extended third wave, so even stronger. This is a weekend, so obviously when volatility is low, when the market's not going crazy in a choppy fashion, we want to take advantage of free money through option time decay, and that's what I attempted to do with this trade alert, with this bullish option spread. That's it for this video. May the waves be with you, and I'll see you guys next time.